My wife insists that Visa is the stock to buy right now. She said, we can be rich buying the stock. I don't buy hype. So I am going to do some study and not follow blindly. But how do I start? The point here is to be rich. Maybe I need to study how much the stock can make me in 10 years' time. Let's do this by estimate. How much is the company profit in 10 years' time? Since everyone in finance is telling me to use EBITDA, I am going to use EBITDA. For those who don't know, you can understand it as a type of profit. I will extract the data from stockanalysis.com. Think about it. Where do you think this number lands? Will the EBITDA be higher or lower? So in 10 years' time, based on the last 10 years, annual growth rate of the company, 12.4%, and assume the growth is slowing down year over year. Visa EBITDA will be $66 billion in 2034. Right now, people is buying the stock around 21 times the EBITDA. It means if a company now profit $1 a year, people will buy it with $21. In the last 10 years, people usually buy the Visa stock with 23 times the EBITDA. As I personally think, dividend received is my profit too. I will be adding up the dividend I am getting in 10 years' time. So, to get the final price of the stock, I will be adding up 23x the EBITDA plus the dividend. The stock price is expected to be $867. Right now, the stock price worth $336, meaning I will earn 1.6 times my investment. Putting in $1,000 will earn around $1.6 thousand in 10 years' time. Sounds like a bargain. But the finance people also says best way of investment is to put in trust fund. To be rich, I would need to beat those giant S&P and QQQ. Similarly, I extracted the data from stockanalysis.com using S&P 500 stock growth in the last 10 years. I am assuming 10 years later, it will be 2.2 thousand, giving myself 2.6 times profit, and QQQ will be giving me 3.4 times profit. Now, in comparison, buying Visa stock sounds like a bad idea, lower than QQQ. But hold up. After some research, they are saying cash is king. Do you think their cash performance can be better than the QQQ? All right then. I am using the same method, estimating the free cash flow 10 years later. The stock price will end up to be around $900, meaning putting in $1,000 will be earning around $1.7K in 10 years' time. Sounds like a bad idea. Lower than QQQ. I personally like dividend. Let's use the same method on dividend gain. The stock price will end up to be around $900, meaning putting in $1,000 will be earning around $1.7K in 10 years' time. Sounds like a bad idea. Lower than QQQ. Let's average all three methods, taking all consideration, and see how it goes. The stock price will end up to be $897, meaning putting in $1,000 will be earning around $2K in 10 years' time. Sounds like a bad idea. Buying Visa can get us $2K. QQQ is getting us 3.4K. Seems like buying QQQ is a better idea. Okay, the number seems terrible. But why? Let's study more about their business to understand more. Let's quickly break down the general information and the segment analysis. Starting from the general information. In short, so what are they doing? They connect banks and merchants and your credit card. They facilitate global electronic payments. They earn fees for processing those transactions. You see, they have this massive global network, a huge competitive advantage. What's next for them? They are expanding, moving into business-to-business and peer-to-peer payments, using artificial intelligence for better services, expanding their network of networks. Okay, I don't think that's enough. I know their story now. But how did Visa earn their money? Maybe we can understand it by knowing how the business earns. Revenue by segment. To understand where is the revenue coming from, 36% of revenue by segment is from data processing. 32% of revenue is from services. 25% of revenue is from international transactions. 6% of revenue is from other. Next, the CAGR of respective revenue by segment. To understand if these segments are growing well, or if there is any outlier on dip or growth. 17% for data processing, which is above benchmark. 14% for services. which is above benchmark 17% for international transactions, which is above benchmark 21% for other, which is above benchmark. In conclusion, the data clearly shows a robust and growing business with the majority of revenue driven by data processing and services. Crucially, all segments are experiencing impressive growth, with compound annual growth rates that surpass the established benchmark. Notably, the other segment, despite being the smallest contributor to current revenue, boasts the highest growth rate, suggesting potential for expansion and diversification in the future. The overall picture is one of strong performance and healthy expansion across the board, validating the company's current strategic focus. So, now we know the potential return and what the business is about. Is that enough to make an informed decision? That is not quite right. You see, buying a stock without checking the financials is like marrying a partner based only on their looks. It's gambling, plain and simple. If you've watched this far, you're serious about investing, and we need to run the numbers. To do that quickly, I developed a 22 checklist that pulls insights from the balance sheet, cash flow, and income statement. Running these 22 checks manually is tedious. So I use the fast download feature at stockanalysis.com to pull everything to Excel for calculation. This is the fastest way to get your insights. You can access the data and my recommended tools through the link below. Use the discount code STOCKSNACK. Starting off with balance sheet, we are checking 7 metrics. Out of the 7, we got 6 metrics with good score. So let's look at the financials. It's actually a clean story. We check their cash first. They have more cash than debt. Simple. It's a good buffer. Then we look at their ability to pay the bills. They generate cash easily, way more than their debts. That is very good news. Now, funding the business. Are they using too much debt? No, not at all. They fund themselves mainly with the owner's money with equity, not heavy on borrowing. That's stable, and here's a key sign of financial health. Preferred stock. They don't have any. Zero. They don't need that special expensive funding. It means banks and investors trust their core business. Moving to growth, can they sustain it? Look at their retained earnings. Money they keep and reinvest, it keeps growing, even through tough times. They showed consistent growth there, very steady. Now, share buybacks. This is an interesting signal. We want to see the company buying back its own stock. This shows they believe their shares are undervalued. But here, the history shows they haven't done much of that. That's a slight disappointment, a small area for improvement. Finally, efficiency. Are they using the money well? Return on equity row, very high. They are fantastic at turning shareholder money into profits. And return on total assets ROTA, also extremely high. They are using their massive global network, their assets, to generate huge returns. Bottom line, the financial engine is incredibly robust. It's efficient, it's self-funded, and it generates a lot of cash. Next is income statement. We are checking 9 metrics. Out of the 9, we got 9 metrics with good score. Let's dig into the core business machine. First up, gross profit. It is huge, massive, really. This company keeps almost all the money it brings in. Why? They have incredible pricing power. They control the network. They set the rules. It's an economic moat. Now look at their selling costs. The overhead, it is tiny, so small compared to their profits. You see, the product sells itself. Once a bank or a merchant joins the Visa network, they are stuck. It is automatic revenue, low maintenance. And research and development, R&D, it's barely anything. Near zero, historically, this is not a business that needs to constantly invent a new phone. It's a simple, powerful toll booth. Next, how heavy is their debt burden? Their interest payments are minuscule, a tiny fraction of what they earn just from operations. They have very low debt risk. They can easily cover it. The tax rate looks normal, nothing shady here. They pay their fair share. It shows integrity with the authorities. Now, the final profit margin, the net income, it is incredible. Over half of every dollar they bring in is pure profit. That is the definition of a powerful competitive advantage. It's unmatched in most industries, and the earnings per share, it keeps going up. Consistently, year after year, this growth is strong. It's beating inflation easily. It's a robust, reliable story. Last thing, debt payback. How quickly can they pay off all their borrowing? It takes them just over 1 year of their operating income. 1 year? That's lightning fast. The machine is financially bulletproof. It prints cash. Next is cash flow statement. We are checking 6 metrics. Out of the 6, we got 5 metrics with good score. Okay, let's talk about how the money actually flows. First, employee pay, the stock options. Are they giving away too many shares, diluting us? The answer is no. It's a very small expense. Management compensation is not overly dilutive to shareholders. That is a green light. Now we hit a snag, a small one. We look at cash flow versus reported profit. Ideally, cash flow should be higher than net income. It means the profit on paper is real, very real. But here, net income is sometimes higher than the cash flow. It's close, but it's a red flag. It tells you to look deeper. Maybe some earnings are on credit. A small warning sign on the quality of earnings. Now, spending money to run the business, capital expenditures. They spend very little. Their capex is tiny compared to their profits. They don't need huge factories or equipment. It's software. It's a network. This low spending is fantastic for cash generation. And where does the cash go? Are they spending it all on dividends and buybacks? They are using nearly all the free cash flow for that, about 90%. That means they are giving a lot of cash back to you, the shareholder. They are not sitting on mountains of cash. They are rewarding owners. It also suggests they are mostly focused on maintaining the network, not massive, transformative, growth-focused spending. It's a mature business. It's giving us back our money. Overall, the cash picture is strong, very efficient. Just watch that cash flow versus reported income line. That is where you ask the deep questions. The combined financial score is good, 20 metrics with good scoring out of 22 metrics. Now, it is time to make the conclusion. So, is what my wife said correct? Will I lose money buying Visa stock? By the profit-wise, buying QQQ or S&P 500 is having more potential than Visa. However, it is having a good financial health. It's a stock worth monitoring. Now, the analysis is complete. Once again, if you need tools for your investment strategy, give a try to stockanalysis.com. They provided sufficient free tools for you to work around. If you ever want an upgrade, promo code is StockSnack. Institutional grade data with less than $1 a day. One day, one stock. See you again at StockSnack.